Well, good afternoon, everyone, and welcome to TradeStation for this fabulous event sponsored by Dan Gramza and Craig Bewick. We're going to talk today about the power of understanding intermarket relationships. First, let me point out our presenter, Dan Gramza. He's the president of Gramza Capital Management and DMG Advisors. He is a trader, consultant to domestic and international clients, and an advisor to hedge funds, and is a developer of ETF securities. He's published works in Australia, Europe, Japan, Singapore, and the United States, and is completing Trading in the Eye of the Storm and the Handbook of Japanese Candle Trading Strategies. He's appeared on CNN's Moneyline program, Reuters TV, Bloomberg TV, ROB TV in Canada, TVN24 in Poland, and other media outlets around the world. We like to have Dan with us almost every month, and so this is a big day for us. Now, Craig Bewick is a director of marketing at the Chicago Mercantile Exchange, or the CME Group, if you prefer. And he won't be able to join us today, but he's contributed in the past to these webinars. We're very happy with our arrangement that we have with the CME Group. Now, my name is Don Prattle. I'm the Director of Trader Development and Education here at TradeStation. I want you to remember that the following presentation is for educational purposes only. All the symbols, all the trading ideas, and everything else we discuss here is for educational purposes and demonstration purposes, and they are not recommendations. This presentation is not an offer or a solicitation of any kind anywhere where a TradeStation affiliate is not authorized to do business. Please remember that active trading may not be suitable for you because it's not suitable for everybody, and options trading carries a higher degree of risk and may not be suitable for all traders. I've included in the chat panel a couple of pieces of disclosure information you may find interesting. I've left it there for you to download and review at your leisure. They are regarding the characteristics and risks of standardized options and the other asset classes that we cover at TradeStation. Now, Dan has posted this futures trading disclaimer, and let me just say, as far as it's concerned, that once again, futures trading is not suitable for everybody because it involves the risk of loss. It's a leveraged instrument. Futures are, because only a percentage of a contract's value is required to trade. It is possible to lose more than the amount of money deposited for a futures position. So traders should only use the funds to trade futures that they can afford to lose without affecting their own lifestyles. And only a portion of those funds should be devoted to any one trade. So you want to be diversified. In any event, any research views that are expressed here are those of our individual author, and they don't represent the views of the CME Group or any of its affiliates. So let me turn things over to Dan Gramza right now so that we can continue on with this discussion. I do want to say one last thing. Usually about now, folks ask, is this being recorded? And the answer is yes. TradeStation records almost all of its webinars, and this presentation will be produced following our completion today, and we'll have it posted to the TradeStation University site tomorrow morning at the latest, tomorrow afternoon. You can also locate these items, all of our educational items, on the TradeStation YouTube page, or if you are a TradeStation customer, and I hope that you are someday, that you would be able to locate these on the TradeStation video station on the trading platform. Now, with all that out of the way, let me get out of the way for Dan Gramza. Thanks very much for coming to TradeStation today.
Hello, Don. Thank you very much. Hello, everyone. Great to be with you. This first slide here, actually, I also produce a daily commentary that's posted on TradeStation. It covers the markets that we're going to be talking about today. It covers 22 markets, 6 different sectors: stock indexes, currencies, metals, energy, agricultural markets. And those are markets that we're going to be looking at these interrelationships. And there's also other providers that provide information. TradeStation pulls together a lot of information and resources, as you probably know, especially if you are an TradeStation client. Excuse me. So please take advantage of that. Well, let's move on here. And the idea behind the video that I do, by the way, is just so that you can see how someone approaches these futures markets. If you don't trade them, a place to begin is to watch them. And this gives a format that you can watch how someone's analyzing the markets and looking at what I call bullish and bearish levels, or buy and sell levels. And you'll see those change as the days unfold with these different positions. So that's the intent behind the video that I produce. Alrighty, now, Craig is, Don mentioned, is not going to be with us today, but he has a tremendous amount of resource in terms of his background to add to these programs, and it's always great to do these with him. My background comes from the floors in Chicago, so I think from a floor trader's point of view, we'll see that a little bit later on when we start looking at markets, because that is what I want us to spend some time doing today, looking at current markets and what is the story that they're telling us. So it has an impact on my background because of that floor experience. But you know something? Today, with the technology that we have, with the TradeStation platform, you and I don't need to be on the floor anymore to have insights in terms of what the market's trying to show us. And I think today is going to be a good example of that in terms of how you and I can go through these various markets. Now, give you a kind of an overview. Let's think about what are the drivers? When you think about intermarket relationships, what does that mean to you? You know, when I think about it, I think about capital flow. When you and I see stock markets going down, that means people are selling it, as we both know. But where does that money go? Or when we see interest rates or interest rate markets going up, where's that money coming from? Or gold's moving. It comes, I believe, if you look at all these different sectors, which you and I are going to do in just a few minutes, what we're witnessing is capital that's flowing between these different market segments. So when stock markets move, or currencies move, or interest rates, metals, energy, agricultural markets, they are all interconnected, just like we all are internationally, globally. So when something happens in some part of the world, we feel it no matter where we are living, depending on what's going on, as a result of that. So I think it's that overview is kind of what I feel about when I look at these different markets. And, you know, economic drivers are something that are important. We have economic reports that come out all the time. You know, when people think about seasonal characteristics of a market, they usually think about things that grow, right? That, you know, there's a planting period, and then there's a growth period, then a harvest period, and all those kind of things, and that's true. But I also think we may have some seasonal characteristics when it comes to, well, when it comes to metals, or when it comes to financial markets. You know, we know that first Friday of the month, we're going to have U.S. unemployment numbers. It creates a certain rhythm for the market to react to. So from our point of view, is there a consistency of behavior when we see those markets moving, or when these economic reports come out? Does the market behave in a normal fashion, the way we expect it to? That if money moves from this sector, it's moving to another sector. And the economic drivers that we're looking at, I think of these ideas or fundamentals, we can think of it that way, in stock fundamental. No one saw that one coming. Where it could be a disaster, it could be a breakout of a war, or it could be something that happens that no one really could anticipate. And then we also have what I call anticipation fundamentals in terms of market reaction. And an example, actually, an example would be right now, I live in Chicago area, and right now in this part of the country, soybeans is at a critical phase. This time of year, soybeans flower, then they determine how many pods we're going to get and then the size of the yield, and it's an important time. Soybeans can be like a weed up till now. So subsoil moisture becomes critical so it can flower, right? So imagine a couple of weeks ago, if the U.S. or Weather Bureau came out and said, because of high temperatures, we're having drought conditions in the Midwest. Now, drought conditions and they're saying drought conditions through the end of August. So those first few weeks of August, right now, is really critical for that crop. So imagine what soybean prices does. It takes off to the upside. You know, you see that market moving up. Is soybean price to our soybean prices moving up because we don't have enough soybeans? No, we haven't even harvested the things yet. It's a moving up on the anticipation that we're not going to have enough supply, that we are going to have drought conditions, which, you know, we're kind of seeing right now around the world. We can talk about that when we talk about agricultural markets, but the issue would be that soybean prices have just moved up. Let's say it moved up $3 on the anticipation that the drought will be maintained, yield on soybeans will be low, we're not going to meet global demand, and prices will continue higher. Now imagine if this week, and actually we've gotten some rain, if we got enough rain to meet crop demands. And one of the things that's an issue here in Chicago, especially when we had the floors, is that if we needed rain and it rained in Chicago, a lot of traders would react like that was the solution. Well, it's got to rain in the areas where we have farms, right? But if we did get enough rain, would soybean prices stay high? Probably not, because the excuse would be taken out of that market, right? So we'd see the soybean market probably coming down faster than it did going up. That's what I mean by anticipation. Another way we see this in financial markets is when you hear the word concern or possibility, or something that implies this uncertainty about something that may be happening. Those kind of words, if you see a market moving on that, the market's concerned about tariffs, for example. The probability of that staying in a downtrend, if that's what the market did, in my opinion, is very low. Because the market is moving on an event that hasn't happened. It's moving on the possibility, the anticipation of something. Anticipation typically doesn't cause a trend change. So we need to be very careful about how the market absorbs that information. So if it does go down because they're anticipating this concern, chances are it's going to finish up and then head right back to where it was before. And we've seen this in the stock market over the last few months. Concerns, anticipation, think about that when you hear about that fundamental. What is it really telling us? Well, interest rates, that has a huge impact on how people react to the market. Because, all of these things that you and I are talking about, what do? They create a belief that people have about a particular market. And they act on that belief by buying or selling that particular market. Interest rates is a great example of this. If you look at Fed funds rate, and here's what I want to show you, by the way. I want to show you U.S. Fed action starting in 1999 and taking us through today. And there's a few points I want you to remember on these. Now, here we are in 1999. Let me grab my little pointer. Here we go. Here we are in 1999. Interest rates are moving up, right? Now, remember, late 90s, we had the dot-com bubble. Now, credit was easy to get. Dot-com companies were just all over. You put .com on your name, just like putting Bitcoin on your company name. People said, oh my gosh, they must really know what's going on. They're on the cutting edge. And also, when the Fed, let's talk about the Fed just for a second. The Fed, their job, they have a few things that are required for their position, their requirements, job requirements in a sense. One, keep inflation low, keep unemployment high, and keep prices stable. That's what they're trying to do. So when inflation moves up, and that's the issue right now, we don't really have high inflation. But as they're moving up, as inflation moves up, the Fed becomes very concerned. And what do? They raise interest rates to help dampen that inflation because they want to lessen the amount of money available by increasing interest rates. All right, what we also know, when the Fed starts doing that, at some interest rate, that credit is going to get so tight, it's going to have an impact beyond what the Fed anticipates. In this case, it was .com. When credit became less available, and the magic number I want you to pay attention to is 6.5%. All right, and then we saw in March of 2000, actually, in May, the market starts coming down. And the Fed says, holy Toledo, we got to do something about that. So here we are, 2001. Look how they decreased the interest rates. Half a point, half a point, half a point, quarter of a point, every month. Boom, 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 boom. They're lowering interest rates. 2003, they lowered again in a quarter. It's at 1%. Remember that number. And at 1%, now people start, credit gets loosened up, right? Companies start expanding because they have easy access to funds. And so here we are in 2004, and they're saying, oh my gosh, we got, whoops, there we go. We got to do something about this. We have potential for inflation. They're increasing, increasing, increasing. 2006, 2007, nobody really saw the real estate market collapsing the way it did. Well, some people did actually, but if you look at that in the bigger picture, it's at 5.25. What did we know? What we know is that people who took out subprime loans and all the stuff that surrounded it, at some price level, interest rate, if they have an adjustable mortgage, they have they're going to have defaults, and that's what happened. So we started seeing defaults, and what did the Fed do? Remember 5.25? What did the Fed do? They started lowering interest rates, and we got down to 0.25%. Here's my point, is that we're looking at the S&P 500 at that high, right there at 6.5%, remember that? And we saw it down at 1%, and then we had it up here at 5.25, and down here at 0.25, which was what we had in 2009. So the Fed policy, interest rates, the reason I'm showing this is it does have an impact, and it has an impact on the markets that we're going to look at. So when you look at the interest rate complex, the sector that we're going to look at in a little bit, it's an important driver in relationships, intermarket relationships with all these other markets. Okay. So another area, Forex, currencies, they also have an impact on intermarket relationships. And we're seeing that now in some areas. And before we talk about that, a measure of value as a medium of exchange. That's what we look at when it comes to a Forex market. Exchange rates is a barometer of risk. I mean, look at Turkey right now. Turkey's currency is at historically low levels. And their interest rates, talking about interest rates, and what you look at in other countries is the 10-year interest rate. So when you look at Europe, if you look at Turkey or any other country, Italy or Spain or Portugal or the United States, a typical benchmark that people look at interest rate-wise is the 10-year. And right now, the 10-year interest rate in Turkey is at all-time highs. Their currency is at all-time lows. It's that barometer of risk. It's the price of money that comes into play here that has an impact on these intermarket relationships. The indicator of an country's economic health. That's what we're seeing right now with the lira for Turkey. Unfortunately, it's at historic lows, all-time lows. Indicator of political stability. Well, we've had some political changes in Turkey. Not just pointing that one country out, but it's a good example of the impact that we have here. And that has an impact on, again, other markets that we're going to be discussing. It's an indicator of the demand for a country's currency. Now, let's go back to talk about intermarket. When we look at, let's see, let's get an example. The United States, our stock market has been fairly strong. If we live in another country, and I've dealt with investment managers around the globe who they look at other countries like you and I would look at a stock portfolio. Instead of stocks, that just happens to be another country. And it could be their local currency, it could be their stock market, it could be their interest rate market that they invest in. But if our stock market's going up, and if I am based in another country, and I look at that and I think I want to participate in that country stock market, I convert my currency to that currency. So that means currency would be converted to US dollars. That creates demand on US dollars, and it pushes theoretically US dollars up. It makes that exchange rate stronger. I believe longer term, that's what I expect to see here in the United States, that the US dollar would get stronger. So that demand comes into play. Crude oil. The cost of energy has a big impact on a variety of industries. We see it having an indirect impact on the stock market. Energy stocks, and today they went up a bit, it has an impact on the stocks and in these indices that you and I can trade. It has an impact on what the people expect for profitability and earnings out of these energy companies. So it has an impact in that regard. It has an impact in terms of production of a variety of industries. So crude oil is an interesting barometer. And one of the things we're going to look at is that currency relationship when we get these markets up here. Now, precious metals, I call it an excuse market. So if you look at gold, if you look at silver, which we are going to do here in just a few minutes, what is it? What does it take to drive those markets? It's a perception of value. And when it comes to gold, where does gold come into play? Well, if we have a weaker dollar, we have high inflation, we have uncertainty in the world, an event that could happen and people go towards value. Gold's considered one of those investments. So we would see gold reflect that. Well, we don't have high inflation right now. We don't have really a weaker dollar. So what do we expect out of gold? And we're going to take a look at that. Based on those ideas, let's see if gold seems reasonable in terms of where it's setting up. Supply and demand also is a driver of these intermarket relationships and the perception of supply and demand. I mean, we see that also with crude oil. You know, the reality is we have a lot of supply out there. The reality is if the Iranian sanctions go into play in November for crude oil, whatever they are not producing, Saudi Arabia can produce, plus as well as other countries. We have to watch out for Venezuela to see what happens with them in terms of their ability to produce and participate in the global markets for crude oil. But we have a lot of excess capacity and we don't have the demand that soaks it up. The perception of what I just said is what helps drive these markets, the belief that that may be true. Now, I want to tell you just one other thing before we start looking at these charts. And it's this. I think all these factors are important. That's why I wanted to talk to you about them before we just jump into the markets. But what determines for me as a trader an action that I'm going to take, it is not my interpretation of these factors. It is price. Price puts money in my pocket. price takes money out of my pocket. So therefore, price is the determining factor. If people are anticipating a future event and this market goes higher, well, then I want to be on the long side, even though I think this long term is not viable. In the videos that I do, I am bearish on crude oil, but I've also had these long bullish levels that people have seen. And people say, well, you say you're bearish, but that shows that you would be long, because price dictates what I do, not my belief. I want that for a market understanding. That's why I think these intermarket relationships are so important. You know, terrorism war creates uncertainty. It's obviously something else we want to be sensitive to. Geopolitical factors. If you look at Washington's relationship now with a variety of countries over a variety of issues, we see geopolitical factors creating beliefs and expectations and concerns. That could obviously have an impact. A stroke of a pen can change everything overnight or instantly. Government regulations can have a big impact. Perceptions and reality of domestic and international economies, what we think is happening in some other part of the world. It can have a huge impact. Weather and storms. If you look at the energy market, when we have a hurricane that comes through the Gulf, you know, about 45% of our refining capacity is in that part of our country. So when you shut down, and the number of offshore wells that we have in the Gulf, I'm not sure how many it is, but it wouldn't be surprised that it'd be at least a few hundred. When you shut those down and you shut the refining capacity down, either in the Houston area, Texas City, or in Louisiana on the Mississippi, it does have an impact on our country. There we see it directly, and we know supply is going to be tightened up. Global demand, especially when it comes to emerging nations, what we're seeing is, and this goes back to the intermarket relationships, we're seeing an evolution as citizens of some countries get more disposable income. I think there's two barometers that you and I can look at. One is the consumption of protein, which typically goes up. And it goes up because people have disposable money. They have a tendency to eat more meat, more protein. To do that, it means that meats have a tendency to go up as a market. It means that agricultural products that feed those animals have a tendency to go up because demand is building globally as that society increases their consumption of protein. So it's something that I think, you know, you and I want to pay attention to. The other area is the consumption of energy. As people have more disposable income, they have a tendency to want things maybe they didn't have before. If you look at China, there are more people living in the cities now than in the countryside. The population, the size of the United States, over 350 million people have gone from the farm to the cities in China. Those people now want things that maybe they didn't have before, refrigerators and all those other things that come along with it. And along with that comes consumption of energy. So I think those are two things when you think about intermarket relationships, the impact of one market to another. When we think about emerging nations, if you want a barometer to look at for that country, watch the consumption of protein and watch the consumption of energy. I think those are helpful indicators of how the pieces may be fitting together. Whoops. Now, for some reason, my slide is frozen. There we go. One more idea, and then we're going to start looking at markets and these intermarket relationships of how they impact each other, and if that impact that we're seeing is normal. Because if you and I have an idea of what a normal intermarket relationship is, when it's not, that becomes really important for us. Because then we have an idea that this situation is not normal, that we expect certain behaviors to occur. So I'd just like to talk to you quickly about what I call behavioral Japanese candles. I first saw candles in Tokyo at Bank of America about the mid-'80s. And I was there to teach another approach called market profile to yield curve traders, which were customers of the bank. We went into the dealing room for me to find some trades in 30-year treasury bonds, which I did. I'm walking out and I see a gentleman drawing these candle charts. And I asked Kuno-san, the gentleman I was with, what are these? And they were kind enough to talk to me about this, but what went through my mind is what I want to share with you, which is the ideas that I would see from the floor. And it's this. As many of you know, if they draw a box between the open and close. And if the closing price is above the open, I have this as green. The traditional color is red, actually. But that's the body of the candle. I think it represents buyers coming into the market. On the other side, when the closing price is below the opening price, I think that I have it as red for a down move. I think that represents sellers coming into the market. It's competition of the order flow that comes into a market that drives price. On the other side of that order flow, oftentimes it's a market maker. And that market maker is in and out of the market in an instant because they're trying to make the difference between the bid and offer. Anytime you trade a market that has a bid and offer, you're trading a two-sided market and you're trading a market with market makers. So they get paid that difference for taking the risk of the other side of our trade. It could be another trader as well. But in general, market makers want the other side of that order flow. They're in and out of the market. The people who, they don't cause a trend. Market makers do not cause sustainable trends. I believe it's the order flow. And I believe that these candles could be a barometer of the type of order flow that's coming into a market. Now on the floor, you would see that by the broker's hands and what they're saying. But I think we can also see it here. Here, the high and the low match the top and bottom of the candles. And if the high price is above, as many of you know, that vertical line called a shadow, I think represents sellers at higher prices. And at lower prices, that shadow on the bottom, I think represent buyers. Now, the size of the candle, overall, top to bottom, is a measure of volatility. The body, color, green buying, red selling. The size of the body is a measure of commitment, measure of enthusiasm for a market. And the shadow, I think it's a degree of rejection. When you look at this on the bottom here, this green candle, when it was trading at the low, at that point, that would have been a red candle. At that level, for whatever reason, the market started trading. Buyers came in and started driving the prices higher. They were overwhelming in the sense you were selling order flow, and buyers are now competing, driving the price higher. And what we're seeing behind them is that shadow. Now, once we got to the open and traded above it, now we see a green candle. So this market rejected that lower price is another way to think about it. So with those ideas in mind, let's take a look at some of these markets. Now, my next webinar, just to give you a heads up on that, is September 4th, and we're going to be looking at stock index futures, how they're composed, the relationships that they can show us, and how you and I can use them when it comes to our market exposure. Well, let's do this. Let's get over here and take a look at some markets. All right, what we have here are monthly charts of the S&P. So we have stock indexes on the upper left-hand corner. All right, so we have S&P, NASDAQ, Dow, and the Russell 2000. And these are the markets, by the way, that I do in my daily video. So then you have currencies, the euro, Swissy, Japanese yen. The second row on the left side, you have Aussie dollar, British pound, Canadian dollar, And then we have 5-year notes, 10-year notes, and 30-year bonds. And then we have gold, silver, and copper. Then we have crude oil, natural gas, soybeans, corn, and wheat. Those are the markets that we have. And if we think about these relationships, how are they fitting together? If we think about, let's start up here on the left-hand side, the S&P. We can see right now, and we can't say much about this last candle. It's a monthly chart. We don't know how this is going to end up at the end of the month. So we really, all we know right now, from the way I would look at it, is that we've had buying so far based on this monthly chart. We'll look at the daily in just a bit. So it tells us that we've seen some buying order flow over the last 3 months as this market has worked its way higher. If you look over down here, we talked about interest rates. So if this market's going up, where does that money come from? And I think one of them is right down here. Look in the middle row over here to the right. That's our 10-year notes. If you look at our 10-year notes, for the same period of time, we've gone sideways to lower. This market's been breaking lower as this market is moving up. So from an intermarket relationship, that's normal. It's risk on, risk off. You hear that term a lot. And when you see the stock market moving up, when you see money being put into that market, that's risk on. And when you see risk off is when the stock market money comes out of that and it goes into the interest rate markets. So if you would see these, the 5s and the 10s and the 30s, if you saw those markets moving up, chances are you would expect the stock market to be moving down. So that's one relationship we could look at. Also, let's look at gold. Gold's right here. And if you look at this shape of this gold market here, those chart, look back at the S&P. They're mirror images of each other, aren't they? Stock market's going up, and then look down here, second row all the way to the right, look at the gold market, it's going down. So we see that mirror image. So we see money flowing towards the stock market, flowing away from capital flow, away from the gold market. And I think that's logical, based upon what you and I were talking about, and that's, do we have inflation? Not really. Do we have a super weaker dollar? Ooh, we should talk about that. But no, not really. So we don't have the barometers that gold needs, the excuses that gold needs to move higher. I think it's a market that wants to go higher, but we just don't see the drivers behind it. And right now, this monthly chart is giving us that overview of that kind of behavior. Now, I mentioned the dollar. Well, let's take a look at it. You know, if you look at the euro, right here's the euro. Let's just, I'm going to squeeze that up a little bit so you can see it a little bit more of what's been happening with that market, and so you can get a better feel for it. So what we can see for the euro for the last few months, since the beginning of the year, basically, let me open that up a little bit. That market's been moving lower. Now, if you're not familiar with currencies, how they're traded, let me just give you a quickie overview of that. What you're looking at is a spread. It's the euro US dollars. And what we're looking at is the relationship of one currency in terms of another. Whatever is first, in this case the euro, it is the value of 1 euro in terms of US dollars. So when you look at this prices on the side, right now the euro is around $1.16. And what we know is this is $1.24 here. So at one time, the euro was more than $1.24. It was more expensive, right? And the euro has gotten cheaper. Another way to say it, now that's in terms of the euro. So the euro is going down, it's getting weaker, the euro is going up. When you look at this chart, if it's going up, that means the euro is stronger. And it means the opposite for the US dollar. It means the US dollar, in this case, because the euro is weaker, the US dollar is stronger. So let's go back to what we talked about, intermarket relationships between these markets. If you and I were going to put money into the US stock market and I live in another country, I would have to convert my euros. If I live in Germany and I want to invest in the United States directly, I convert my euros, which means I'm selling euros and I'm buying US dollars. And so we're seeing the US dollar getting stronger and we're seeing the euro getting weaker in that regard. And you know, we've had some positive things coming out of Europe. I don't want you to think that it's because everything is going south. I mean, if you look at Germany yesterday, factory orders were down a bit, actually the most in 17 months. But if you look at some of the information we got today, Germany's industrial production was down a little bit more than expected. But we're seeing some other countries that are also hanging in there as well. But we are seeing some softness. That's probably reflected here as well, too. This whole Brexit issue has some impact on what people believe could happen. And if we take that relationship here from the euro, let's look down at our friend here, the British pound.
Hey, Dan.
And what? Yeah.
There's a recurring question in the chat panel about the S&P, why you're displaying it on a daily.
Oh, well, that's because I made a mistake there. I thought I had it on a monthly. Let's change that. Thank you, Don. Good man.
We've got the sharpest.
Was actually a test.
It was Sharon that pointed it out.
Well, Sharon, I have to tell you, the test. I just wanted to see if anybody would notice that. And doggone it, you did. I'm very impressed. Thank you, Sharon. I'm glad you pointed it out. Looks kind of similar to that daily chart, doesn't it? And actually, I was just kind of focused on the shape of the chart. But you're right. No, the reason it was a daily is because I didn't realize it was a daily. I wasn't trying to show something with that. But thank you for pointing it out. But what we're seeing, though, is that same kind of action, right? You know, not too long after the first of the year, we're seeing this market getting firmer, getting stronger. So the relationships we looked at, stock market getting stronger for the S&P or for the Dow, NASDAQ, this is the NASDAQ, Dow, a little firm, it's lagging behind, and then the Russell's kind of been a struggle. Russell's totally unique because it's a different composition. It's mid-cap to small-size companies, where over here you're looking at large-cap companies, and the drivers there are different. Also, when it comes to, we're talking about these currencies, the issue here when it comes to the S&P is that we want to remember that 45% of its income comes offshore. So when we see an impact on some of these variables, like the crude oil that we talked about, or the currency, it does have an impact on the revenue expectations for those companies. So that's why sometimes when we see crude oil doing certain things, we see the stock market getting jittery. But if you look at the British pound down here, you know, we see a market that's been breaking lower, and there's a lot of uncertainty. You know, Theresa May really has her job cut out for her in terms of trying to get this to keep everybody happy. And it's a big job. It's tough. They have to remove 6,000 laws from their books. They have to renegotiate 1,100 treaties. They haven't been able to do that yet. So it's, and you know, right now the EU has to agree with some kind of an arrangement of what's going to happen before and what's going to happen after the Brexit. So, and we got March of 2019 coming up here when that's all supposed to be done. By the way, under the regulations, they can extend that period of time if the EU approves, if they're not ready at that point. So there is an outlet to extend it. But what we're seeing here is logical, I think. We're seeing the British pound actually getting weaker through this period. You know, again, it's a mirror, and it also says that the dollar is stronger, right? We're seeing the US dollar stronger against the Aussie dollar. We're seeing it stronger against the Canadian dollar. Or here with our friend Mr. Yen, we're seeing it stronger against the yen and stronger against the Swissy. So that kind of behavior I don't think is totally off kilter. think it's somewhat normal. If you look at that intermarket relationship, Japanese yen is unique because it can act as a reserve currency. So when you see weakness in the US dollar or the US dollar getting stronger, oftentimes you may see that reflected in Japanese yen. It is one of the places that money will flow to. The Swedish kroner is another one that capital will flow to in times of uncertainty. Polish zloty used to be like that, but I don't think it's so much that way now. So far what we're seeing with the US dollar and these currencies, I think somewhat makes sense. Canadian dollars, our friends in Canada, you know, we buy more Canadian crude oil than any other country. When we import crude oil, by far the largest amount comes from Canada, our friends in Canada. 63% of our natural gas exports goes to our friends in Mexico. So what we're seeing here, what we want to pay attention to in Canadian dollar is what's happening right below it, and that's crude oil. It is, you know, Canada and Australia are considered resource economies. They're considered commodity currencies because they have a tremendous amount of resources, and that's a major source of revenue for those countries. They're about the same size, over 20 million people. And so resources are critical. Well, crude oil is a big deal when it comes to our friends in Canada. And so where crude oil goes, oftentimes you want to look at is the Canadian dollar also behaving that way? If crude oil is getting stronger, is the Canadian dollar getting stronger? Do we see it reflected there? If we see a weaker US dollar, that means these charts are now turning up, the currency charts. Then we look for higher crude oil prices as one of the variables to drive that. And right now we're trading around $70 a barrel in crude oil. And that's, you know, what OPEC came out with. Saudi Arabia basically said we like the idea of $70 a barrel. Ideally for them, they pump so much money into their country, the billions they put in since the Arab Spring, ideally it would be $100 a barrel, would really balance their budget. But so we're seeing that relationship between the dollar and the crude oil market. That's an important one to monitor. And right now we're not seeing anything unusual there. We are seeing things firming up in natural gas, but here's what I want to point out about natural gas. Natural gas is used in the United States to heat our homes and to cook our food. About a third of it is used for that. Another third goes to produce electricity. Right now in the United States, we produce more electricity with natural gas than we do with coal. And if you look at the third area, that is industrial use of natural gas. So steel industries, chemical industries. We've seen our chemical industries expanding because the low cost of natural gas, a key component. They're high energy users. But what's interesting about this, I want to point out to you, remember we were talking before about the shadows on the bottom. The way I interpret this is that it represents buying. Well, what do you and I know below 280? Look, right here is 280, right? Look at all those shadows below my little hand right here, right? You see nothing but shadows all the way across the board. Now, when you see that, it tells us a couple of things. One, it tells us that buyers are coming in below that level. It also tells us that if we're a seller of natural gas and it approaches those levels, we should be sensitive to the fact that it may find buying. It also can reflect hedging. When you see what I call consistency of behavior, where you see, you know, like these shadows across here, that's consistency of behavior. That kind of action implies potential for hedging. So it gets down to that level. These high consumers of natural gas, they say to themselves, you know, if we could buy natural gas below 280, that could really help our profitability. Well, when it goes below 280, those hedges get locked in. And that's what you're seeing sometimes when you see that type of behavior. So it's just something to keep in mind when we look at that. When we look at intermarket relationships, these energy prices also have an impact over here in the grain markets. We use a lot of energy when it comes to producing food, not only to fuel the tractors, to plant the product, to make sure the weeds stay out of it, and when they fertilize it and all the other things that they do, and also when they harvest it and to get the product to market. So they're high energy users. Fertilizers also utilize natural gas, so they're a high consumer of that as well. And we've had some interesting things going on. If you look at over here to the right, wheat. Now wheat firmed up a little bit here on this monthly chart. And the wheat situation globally is what you and I want to think about. Um, if you look at Germany and France, they have drought conditions when it comes to wheat. France is the largest producer of wheat in the European Union. If you look at Russia, Ukraine, Kazakhstan, very large producers of wheat. So when you hear about China now looking at the Black Sea to buy wheat, that's who they're referring to. But Ukraine just recently came out and said, you know something, we're going to have to restrict our exports of wheat because our yields just aren't there. And you know something, you and I have seen that before, or I have, and maybe you remember it. Not that many years ago, about 10 years ago, when Ukraine also, and so did Russia, cut back on wheat exports because of yields that they had. And that was the beginning of a very strong trend. If you look at Australia, they have drought conditions where they're growing wheat. Canada, United States and the Great Plains, we have some really dry conditions that can really have an impact on that. So it's, if you look at the Ukraine, just to give you an idea, they're the fifth largest exporters of wheat. And the largest importer of wheat is actually Egypt, if you look at that country. So we have some interesting things going on there right now for that market. And when I think of the agricultural markets, I do think of energy. I do think of the US dollar because we know that has an impact here. The US dollar is stronger, as you and I just went through up here. Well, that's not friendly to when you're trying to sell stuff to other people because our products, our agricultural products, become more expensive. And right now, our wheat is more expensive than Black Sea wheat, than China going to Russia to buy wheat. So all these capital flows that we're watching in between these different markets, they all really come together when we look at these various markets. A market that I was, and I had been, if you go back to videos, you can go back, I think 7 years on the videos that I produce. And I said for the last, I don't know how many years, I'm bullish on copper. I'm bullish on copper because of what we see in China. And that is China consumes enough copper every day to wrap a wire around the world 100 times. And they have these new consumers they have to produce stuff for, the people that move to the city internally. Plus, they have to make stuff for you and me. So if you look at China, look at the United States, and look at Germany, those are the three top consumers of copper. And that used to be a barometer of the economic health of an economy. If copper consumption's going up, we expect prices to firm up, and it means people are producing stuff. And if countries produce stuff, people buy stuff, and that's what drives the GDP. 70% of the GDP in the United States is from consumer spending, from people buying stuff. So it all comes, and that means that companies do better, and it goes back to our stock market. Our stock market then should improve. And I just want to give you a feel for where things are today. Now I can show you daily, which you've already seen in the S&P. We're seeing some follow through today. That's what I was talking about in the video. 2862 was my objective for that market today, and I think we have gotten just a tad bit above that. That's right on target in terms of its movement. The Dow, this was a very important day for the Dow because we're above those swing highs. So all these things that we were talking about. So we're seeing stronger stock market, right? The NASDAQ's up, Dow's up. Russell's still lagging behind, but it moved up a tad bit. And we're not seeing a stronger US dollar on the daily chart. We're seeing a stronger euro here. And that stronger euro means the US dollar got weaker today. So can we get follow through? Tough job ahead, I think, for the euro. I don't look for the same size of move tomorrow, but we're going to have to watch this one closely. We may get some stronger moves to the upside near term. I love the interest rate markets. Look at the 10-year notes with me down here in the second row, right? We're seeing strength in the stock market, and son of a gun, we're seeing weakness down here in the 10-year notes, right on target. 30-year bonds, boom, down. 5-year notes, boom, down. That's what we want to see. So it's logical. We're seeing capital flow between those two sectors. I think it makes sense. Look at gold. Look at consistency of behavior. Look at every time it's rallied, somebody has been selling it, right? And does gold have an excuse, if you think about all these other sectors, to go up? I just don't think it does. I'm not super bearish on gold. I'm kind of neutral on it. I just don't see a reason for this market to take off to the upside. Now, copper firmed up a bit. We did have a drawdown in supplies in China and Shanghai of some of the supply of copper. So that's helped stimulate this a little bit. But the issue is, can we get follow through? And 280 is the next big challenge for that market. So we'll have to keep our eye on that. Crude oil, I think, is behaving as it should. Plenty of supply. We're seeing sellers coming in for the last 2 days. The big issue with crude oil, though, is can we get follow through to the downside? We haven't seen that kind of action. But watch 68 down to 67. That's where we could start seeing those buyers coming back in. A sideways move over the next few weeks for crude oil would make sense. So I think we'll have to keep our eye on that. Natural gas is firming up because we had supply drawdown. And again, the grains, as we talked about, really are going through some challenges right now. They all imply that they want to go higher, but we'll have to see what happens with the US dollar. We got to see what happens with yields that we get here and what the global situation is for these markets. The wheat market, though, it could be very interesting, I think, in terms of how it unfolds. So I hope this is giving you some ideas to think about these relationships, the things that drive one sector compared to another sector. And that's what I mean by intermarket relationships. The last thing we could look at would be spreads between these. And when you look at a spread like this, it gives us a ratio between these two markets in terms of how they're moving. We can look at, is there a seasonal characteristic to this market? Is it behaving in terms of normal action? We know gold between September and February has a tendency to go up because of holidays, Diwali and Ramadan and Christmas and the Chinese New Year. Can put demand on gold. So are we seeing something? The size of movement and that time, is that in line with what we normally see as a relationship between these sectors? So if we're looking at the stock market going up and interest rates going down, is that true? Well, a relationship chart like this, a spread chart, could give us those clues. All right. Now, let me just take you back to our slides here. Hopefully that brought you back to this point. And I just want to thank you for sharing part of your day with me. I hope you got some insights into what these are. I just see over here, China now leases large land in Ukraine. You know something, I got to tell you, that's a very good point. And not only do we see that, but we see, well, China purchased a mountain in Chile, a copper. They're moving a village. That copper mountain is a drop in the bucket what they're going to need long term, but they need resources. I'll tell you another one that's kind of interesting to me. We've been hearing so much about the tariffs. Well, China is the world's, again, talking about consumption of protein, China is the world's largest consumer of pork. And we've seen that increase by hundreds of percent over the last 5 to 7 years. Anyways, China imposed a 25% tariff on imported pork from the United States. Smithfield's, a company in the United States, is one of the largest producers of meat in this country, and they produce the largest producers of pork. And that company is owned by the Chinese. But if you look at China, gosh, in fairness to them, they have such huge demands domestically on resources. So that's why you see them spending a few $100 million to build roads in the Congo. Eventually, they're going to need resources coming out of that part of the world. They have rights to the copper in Afghanistan. So, you know, the demand that they need when you have a population that large, it's a tricky job. It's really tough to do that. Oh, Robert just asked about feeder cattle. You know, the meat markets are really interesting, aren't they, Robert? I think they just really fascinate me. Let me see if I can pull. Where did I do that? I had those up here. Yeah, let me tell you what. Let's do this. I know I gotta get going here, so I'm keeping you guys too long here. But let's do this real quick. I'm gonna hopefully right now you see charts in front of you, and let me go back to. Let's go back. I'll take the Aussie dollar, and let's look at feeder cattle. This is a monthly chart I'm looking at, Robert. And what we're seeing is a market that there's just a lot of uncertainty. I mean, let's look at the overall environment. Here, let me show you this a little bit better of feeder cattle. First, is it cheap? Is it expensive? Now, I picked a monthly chart because I know over the last few years, last 4 or 5 years, we've had a lot lower prices and we've had higher prices. And we're in the lower third of that range. So right now, feeder cattle is not extremely low, nor is it extremely expensive. If we look at the last few months, I want you to notice this large red candle. I call that a benchmark candle. It implies weakness. If you look at the last 2 months, we've had shadows on the highs. They've been, again, you can't say much about the last candle. But what we're seeing so far is selling coming into that market, weakness in cattle. And what's interesting about this is people, oftentimes you hear them talking like the meat market is an instant supply market. It's not. It takes about 2 years when a calf is born to get it ready to go to market. So there's a lag time there. And when we see prices getting depressed and people take their herd to processing sooner, earlier, it really creates that lag behind. And then we have a tight supply and then demand can push it right back up. So right now we don't see that environment, but the overall environment for feeder cattle here is bearish. But here's the thing I think that you and I should think about on the downside. Look at these shadows. See the ones down here? Now, if you look at these two together, one on top, one on the bottom, I call those containment shadows. In fact, on the floor, I used to call that a broker's deck. Because we have sell orders up here and we have buy orders down here. These last two candles imply a sideways market. So for feeder cattle to go sideways here, to lower, I think would be a reasonable expectation for that market. Let's just take a look. Whoops, come on, get up there. Let's take a quick look at the weekly chart. And so far this week, we have seen pressure on this market. But it's not unusual behavior for feeder cattle. I would not look for the same size of move. This is, again, a weekly chart, so we can't say much about this. It's not done yet. Let me show you the daily, just so you get a better feel for that. There we go. It's right at levels that we found buyers before. The next level we got to look at here is 146 down to 145, this level right down here for a potential bounce. So we're seeing pressure on the downside. Sideways move wouldn't be surprising. And I think the next few weeks are going to be very interesting for this market. And I hope that helps, Robert. Thanks for asking about it. Okay, well, thank you. I'm glad. Whoop. I hope I got everybody's question here. Can we put volume beneath? Yeah, we could put volume down. Excuse me. We could put volume down there. Another measure of market acceptance that we could look at. And the view on the S&P, I'm positive. You're welcome, Robert. I'm positive on the U.S. stock market. I'm bullish on the S&P. I do look for follow through, and I'm looking for a strong close this week. I think the fundamentals right now support that kind of action, and that's how I'm looking at that going forward. Well, I hope it's given you some insights into market interrelationships. Really looking forward to exploring stock indexes with you next month, September 4th. In the meantime, I wish you well in all your trading efforts, and thank you for sharing part of your day with me. And Don, as always, thank you for your guidance. I appreciate you making this possible, pulling all the pieces together for us.